Welcome everyone for this week's Traders Desk. So on the agenda today, we'll take a look at what's happening on a macro level. We'll need to make sure we're on top of this. We'll also look at a few trade ideas, mostly from a post-earnings perspective. So quite a few companies have reported earnings in the last few weeks. So I think it's important for us to be on top of these earnings and from there on, try to generate trade ideas. And then finally, we'll have a Q&A session. So we can, you can unmute and we can discuss whatever you want to discuss, all your pressing questions. Before we get started, this is not financial advice. This is purely for educational basis. To read the disclaimer. And then all the material is copyrighted and owned by the Financial Traders Hub. When we talk of macro, right, I think the most talked about macro for this week was inflation, right? And most interestingly, what was of, major notice for all market participants was that the US 10-year yield did not rally further, even if we had a CPI report and a PPI report that were both above expectations. So this is a bit puzzling, even for me, right? Because we would expect that the long-term rates start going higher, especially as CPI, which is a clear indication of inflation, starts, creeping back upwards, right? But the bond market is not acting in that manner. So this is something we have to take note of. And the reason why we need to be on top of this is because equities, or the price of equities or the valuations of equities are directly linked to long-term rates, right? So if rates go back to $5, there are many companies that would fall by 20, 30, 40, 50%. If rates go to, let's say, 3.75, if the 10-year yield goes to, let's say, 1% lower than where it is now, there are many stocks that would rally 100, 200, 300% from here. That's how sensitive these stocks tend to be with the long-term yields. So that's why it's important for us to understand what the bond market is thinking and what could be happening under the hood. And that gives us a little bit of foresight in terms of where the bond or the long-term rates could go. So my view is still that we are experiencing an uptick in inflation. I think we're going to see another bout of inflation from here. I'm definitely puzzled by the price action in the US 10-year yield. I think the market has it wrong. It's quite a bold statement to make. I think the market is reading a bit too much into what Trump is saying around, all the wars will be resolved. So wars are highly inflationary in nature. So of course, if the Russian and Ukrainian war is resolved, that will bring down inflation through different ways, right? One is the price of oil could come back lower because, hostility, geopolitical risks normally causes the price of oil to go up. However, I would argue that this is probably not going to change much because the Russian oil is already in circulation all over the world. So it's not going to be a situation where now Russian oil adds to the existing supply of oil. If anything, even the oil in Iran and all these places that supposedly have sanctions, they're all floating around, and some of them are, even in Europe, in the US, because it just goes through different parties that then kind of whitewash the oil, right? and then make it sellable to other parts of the world. So, as an example, when Russia was sanctioned, they were selling a lot of their oil to China and India, and then China and India would just resell these to the European counterparts, uh, and somehow that oil becomes you know fit for consumption, right? So if you buy directly from Russia, you cannot do that. It's under sanctions. But if it goes through India, China, and then it's resold, then somehow it's accepted within the system. So that's the reason why I mentioned that I don't think that the price of oil will go down because of Russian oil coming back online and so on, and adding to the supply. It's already there. I think the market is also probably reading a bit too much into all these government efficiency gains cuts by Elon Musk and his bunch of nerds. Definitely government is probably the least efficient area of the world. So I'm not surprised that he finds ways to cut expenses. But let's be honest, right? It's that's not what's driving the U.S. deficit, right? It's not paying a couple of 150-year-olds pension, or a couple of extra staff that government has employed, right? There is room for right sizing that for sure. But the U.S. deficit spending is much bigger than all of these items, and of course, if the conflicts in the Middle East and in Russia are resolved, it probably means that the U.S. has to spend less on sending arms and all of these things to Ukraine and to Israel. So maybe from that perspective, the market perceives that the US deficit spending will be reduced. And that's been a big factor in fueling inflation, right? It's been a counterforce to the Fed rising interest rates. So on one hand, the Fed is saying I'm increasing interest rates to tighten monetary supply, and on the other side, the government is just spending a lot more, which is highly stimulative to the economy, and thus creating inflation. So that's my view on it. And of course, there's another scenario here where the market would be right in terms of what it's doing. That would be we also had the retail sales report this week, which was a big disappointment, right? So that's leaning towards us believing that the consumer is not as strong as it was made to be. If you look at the retail sales, I think it barely grew, or even if I think it was like 0.1% or something. We can have a look at that just now. So retail sales is a bit of a lagging indicator. So it tells us about what's already happened, but it gives us a good idea of how strong the consumer is. So if the market is thinking that the consumer is going to weaken from here, spending in the economy is going to reduce, then obviously that's not inflationary, right? So from that perspective, the government 10-year yield would drop, because it's not dropping because you're correcting inflation. It's dropping because it's projecting deflationary scenarios, right? So basically, a cut in demand that leads to GDP slowdown and eventually a recession, that kind of an environment. And if that happens, then if that scenario is what the bond market is pricing in, then that's certainly not positive for equities. So I'd like you to unmute here and just make sure that, if you have any questions on this topic, just make sure to address it to me, because this is a very important junction, right? There are two scenarios. One is where, growth holds up and somehow inflation gets resolved, right? And then there is another scenario where growth itself, takes a big hit, and then we tailspin into a recession. And then there is a third scenario where growth holds up, and then we experience an uptick in inflation, right? I cannot see any further scenarios. I cannot see a scenario where growth holds up and inflation gets back into control. That I think is very hard for me to see. Trump thinks he can get the oil price much lower. I doubt how much lower he can get that to, because even if he gets oil down to, let's say, $40, right? That's going to cause a big correction in inflation, sure, but $40 now versus $40 5 years ago is a big difference, right? So if you want oil to go to $40 now, it's almost like bringing oil at $20 5 years ago, which is something that would never have happened. Of course, I don't have all the answers. This is how I'm thinking about it from a scenario perspective. So I'll give you a chance. If you have any questions, feel free to unmute and ask me anything you'd like to.
So, Roshan, when you say the long-term rates are coming down, but we don't have a clear answer, but we have some scenarios around it.
Mm-hmm.
As a trader, how are you thinking about your portfolio at this point,
Yeah,
given that?
it's a good question, right? The reason we have these scenarios is to have one idea for all these types of mutually exclusive scenarios. Yeah, because I don't know where things are going to head. So if we are going to see an uptick in inflation, I want to have an idea linked to that. If we're going to see an uptick in or a downtick in inflation, then I want to have ideas related to that. If we're going to go into a recession, obviously I want to have a few ideas around that. So the whole thing is, if I have 10 ideas, I'm not expecting all 10 of them to work, because I'm being very deliberate in terms of how I'm picking these ideas. Yeah.
Okay.
And of course, as the market keeps trading, I think we'll get an understanding of which scenarios are being priced in more than others. Yeah. As we get more data points as well, then at the moment you can see there's a bit of uncertainty, right? If I look at the data, my own personal view is that we're heading to see much more inflation. So in my if I was not looking at the way the market is trading or the price action, I would definitely say by now the US 10-year yield should have rallied to maybe 4.78, because inflation is coming. There are all the signs, but that's not happening. So that also is a data point in itself, right? Because I might feel one way, but the market is not necessarily looking at it from that perspective. With all the talks of tariffs and all of that, I think that's also another source for inflation. If you know, there's a lot of arguments that inflation is just like a one-time hit. It will only impact CPI once, which yeah, might be true. But there's a lot of other aspects that people are not thinking about. Import tariffs could literally mean some companies having to set up new supply chains. That in itself is inflationary. It might mean that you're incentivizing a lot of local production in the US, which is great for economic development. But building a factory, setting up machines, and all of that is inflationary, right? If you're going to be buying more steel, more warehousing space, more logistics, all of this is inflationary in nature. So I cannot see a scenario where tariffs or tariffs are deflationary, unless if you know tariffs basically cause people to stop buying and selling and trading. That's one thing, and the other thing is we've also seen the dollar take a bit of a hit this week. So if we look at the dollar here, this is the dollar index. So it's kind of a basket weighted index for the dollar against, I think, 8 to 10 major world currencies. You can see, right, in the last few weeks, the dollar has kind of peaked and it's now coming down. So, when the dollar comes down, what does that mean? It means your imports are gonna get more expensive, and add tariffs to that, and your exports are going to be less. So your exports are going to be less, not expensive, but less valuable, right? So I think that to me is something to keep watching out for, and most specifically, this is the one to watch: the USD against the Japanese yen, right? We've discussed about this long and hard. I would not be surprised to see a big tech sell-off as this keeps coming down, right? It might not be sudden. It might just be prolonged day by day. I was looking at the flows earlier into the QQQ. It's still having a net inflow on a 3 month basis, but it's also important to just take a look at these, right? So all this information is available freely on the internet. So let's look at this. So this is the flow into the QQQ, which is an ETF for the Nasdaq 100. So on a 3 month basis, it's still positive, right? $8.35 billion that went into tech stocks. But if you look at the last few weeks, right? And this is until the 12th, right? So I think this is Wednesday, yeah. We'll get the next data point on the 19th. I would not be surprised to see a flurry of red from here onwards, especially if the USD is coming down. So these are the type of things to keep watching out for. This would give you a very good idea of what's happening under the hood. Obviously, as the long-term rates come down, one would expect that tech should be doing better, right? But if you look at, there were quite a few stocks in the tech sector that have sold off quite a bit on the basis of fundamentals. So the Nasdaq was up 0.42% on Friday as the long-term rates were coming down. So my view is that this relationship between rates going lower and the Nasdaq might no longer stand as powerfully as it used to be in the past. In the past, it just used to be like a one-to-one inverse relationship. Rates have come down quite a bit, and the Nasdaq it rallied, but it was nothing spectacular. And if you were to look at the stocks under the hood, a lot of them have not been doing that well. So yeah, that's basically what I'm kind of looking at the moment. So this is the retail sales.
Roshan,
That
can I ask you one quick
Yeah,
question?
go ahead.
You mentioned about the USD coming down and the USD versus Japanese yen.
Hmm.
Both mutually exclusive, or there is some connection to that too? Like, why uh, why the relativity and the USD coming down both are, yeah, I don't know, are they both connected?
Um, are you talking of whether the DXY and USD JPY
No,
is
I mean,
connected?
if the USD is coming down on its
Mm-hmm.
own, will
Mm-hmm.
that also drive that relativity of USD and JPY down?
Yeah, yeah.
Are they both
Yeah, I
connected?
mean,
Okay.
if the USD itself as a currency is coming down, so USD divided by JPY will come down if, without the Japanese yen having to appreciate a lot, right?
Yeah.
But if that's also happening, then that pair will go down quite a bit.
Hmm. And
And
what could be the reason for USD coming down? Is there something that we need to think about? Like what's the reason, or we don't have to. We just have to
um,
watch this
I
charts
mean,
and
you
understand
you
it's coming down.
you could think about a few reasons. I don't have any in mind. It could just be that people who are long dollars are now closing their positions. If you see, right, being long dollar was the trade for a long time, right? So from September actually, it's been rallying to 110, and now it's correcting a bit. So it could just be a correction, or it could just be, that it goes back into this range, right?
Hmm. Okay, okay.
So we don't know. Actually, this is a range that's been holding up for a number of years now. It's come into the range, so I don't know if it will bounce off or if it will just keep getting range bound here. So what I'm saying is there's quite a bit of room for this to move now.
Mm.
Another thing that I was looking at this week. So obviously with inflation, you'd expect gold to go up, right? And with a falling dollar, you'd also expect gold to go up. But gold was down 1.6% on Friday. Let's put a daily chart here. So you can see, right, for the on when the CPI report was announced, gold was up. When the PPI report was announced, gold was up again. And then on Friday, gold gave back a lot of the gains. Yeah. So for these 2 days, the US 10-year yields were coming down while gold was just rallying. And then eventually gold just uh, got got sold off a bit here. So these are the types of things you have to keep looking at to be able to sense and understand what might be happening under the hood. These are the things to keep watching out for. I think this is a report that we need to look at in a bit more depth. So when the report comes out, typically what you would see, um, if you're following these reports, you probably will see something like this, right? Like an economic calendar. That's okay. So normally this is what you would see, which is basically the reports that are coming out, and then what's expected, what was the report value last month, and then you would have the value for this month, right? But for important reports, what I would suggest is that sometimes what you do is you go into the actual report and get an understanding of the underlying information, because they don't just give you one number. They give you this whole detailed report. They will give you segments about what you see, all these different segments, right? And we do trade all companies that sell these types of products, right? So for us, it's important to take a look at these numbers and just get an understanding of whether our view and what's happening in reality is matching, or whether there's something that is conflicting with our views, right? So typically what you would do, and I'm on investing.com, and then you go into the economic calendar. So you basically just click on this. Then it will give you this chart over here. And sometimes you will have the source here. So you just click on this and it will bring you to the report. So all the lazy people in the market just look at these headline figures and then they never spend any time actually looking into the reports. And it makes sense that the guys who look at the report in the right level of detail would be the guys who, have a better understanding of what's going on. So from here, you basically will be able to get to this document that I've got here. Any questions? No questions? Okay. So retail sales was down 0.9%, right? Um, I think what was expected was a print of minus 0.2%. So that's quite a significant drop compared to what was expected. And it's significant because retail sales is a bit of a measure for what the US consumers are doing. And the US GDP is highly linked to US consumer spending, right? So this is why this was a big report. And when that came out, I think you started seeing a lot of moves that you would typically see when GDP slowdown will happen, right? So long-term rates start falling, equities sell off, although we did not see a sell off in equities. Even if I were to look at discretionary segment, right? So this is the consumer discretionary. It sold off like, very little, 0.04%. You'd expect this to be down significantly on such a bad print. So is the market just completely dismissing this and thinking that Trump will be the one who solves this? There is a theory out there that he's going to abolish income tax. So, of course, if he does that, that's basically like putting more money into the US consumer's pocket. And the next thing that they'll do is just spend it. So, there is a school of thought that says anything that we're seeing here, we should just dismiss it because, he's going to be taking measures that make the US consumers a lot more stimulated to spend. But of course, we haven't seen anything of that nature. We don't even know if this is something that is feasible, if he'll be able to implement that within, the right timelines or not. Knowing the US, the level of bureaucracy and everything else, I suspect this would just be like an immediate thing that he announces on Monday. But you never know. Yeah, so what I'm interested in is to understand where this drop came from. So this is interesting, right? This is uh, the black part here is basically total, and then they break it down into ex auto, excluding autos, and then general merchandise. So in November, retail sales were still positive, driven a large part by auto sales. Yeah. Then in December, still positive, slightly higher, driven a large part by stuff that do not include motors, right? No, sorry, driven a large part by the auto industry again, yeah. Um, and then in January, total was negative, so negative 0.9%. Um, and then that was driven by like auto segment just going the wrong way. Yeah. So you remember that I was mentioning when I was discussing automation that in towards the end of November and December, there was a lot of sales of EVs because people were afraid that Trump will take away the tax rebates that the US currently gives related to purchases of EVs, right? So before he implemented the abolishment of that tax rebate, People were just rushing and buying a lot of EVs. And that's also been well documented. It's also been discussed by the companies themselves in the earnings call. One analyst called it the Trump bump, right? So that's a good term. I'm gonna use it for this. So we are seeing the Trump bump here, right? Over here and over here. And now getting into January, it's looking like we're back to, the same dismal state that the auto industry was in. This is how you need to be thinking about things. You don't just look at charts and numbers, but you also need to understand what's happening on the ground and what's explaining these outliers. Another thing that I typically look at is this segment over here, right? Also, keep in mind the numbers we are looking at, these are advanced numbers, so they are not yet confirmed. How do they call it? Yeah, so you have a preliminary estimate and then you would have a revised estimate, right? So in a few weeks, we'll get the revised estimate for the January retail sales. I think typically there's like a lag of 1 month. And this number, which is zero point 0.9, can be slightly higher or slightly lower even. So typically what I use this report for is I want to understand what's happening to prices in different segments. So in this case, what I would be looking out for would be percentage change, maybe. Um, is there something you want to say? No, I think someone just unmuted. Anyway, I'll carry on. If you want to say something, just feel free to unmute and chip in. So in this case, what I want to look at is, um, so this is basically, I guess this is 1 year, 1 year. Yeah, so typically what I would look at is this column over here, right? So this is basically month on month changes from December 2024. Okay. So at the moment we have the January advance and we're comparing it versus the December preliminary estimates. So what's evident here is that the price of cars is going down. It's not a surprise. We know about this, right? Other segments that are also going down, sporting goods. So if someone wanted to go along Nike or something, which is heavily involved in sporting goods, you would typically look at this and say, maybe this is not the place to be long Nike, right? Because prices are coming down, it's going to put pressure on margins, and you're not at that point where Nike is going to do well. Where is it trading? I'm not sure. Let's just quickly look. Yeah. So if you look at Nike on a weekly basis, uh, it's still in a downtrend, right? So it could still be a long, right? But if you go long, you need to have very good reasons for that. There's nothing else that's notable. Probably furniture and home furniture stores, right? Still quite a big drop because remember this is a month-on-month analysis, right? So down almost 2% is quite significant. And then yeah, this is another thing to keep, these two, clothing and clothing accessories. So I think we were discussing being long apparel a few weeks, or I cannot remember exactly when. Once again, this is something to be a bit careful of, right? If we're seeing deflation in the prices, it's hard to make a case for a long idea within this sector. It's not impossible, but you have to be aware of the prevailing trends. On the other side, if you wanted to be a short, right, these are the areas where you would start going and try to understand whether prices are correcting there and whether margins are being crushed and so on. And also, just because this number is negative or has been negative in the past month doesn't mean that you're going to short stocks within this segment, right? These are just clues to get you to start looking into different segments, looking for the right elements for your trades. This is not confirmatory in itself, right? The other thing to note is building materials and suppliers and dealers and everything down 1.3% on the month. I think we've discussed a lot about housing and these building materials suppliers. We are seeing it definitely in their numbers too. And that's the reason why we are short. So it's good to see this actually happening at at the report level too. I think this is probably the same thing, different metrics. So nothing much else to see here. Do we have any
Roshan,
questions? Yeah,
I do actually.
yeah. Go ahead.
Have you, I mean, I know how we keep a track of the ISM reports. Have you ever looked at this one as well in terms of like looking at the trends and if
Um,
there's any reversals happening
not
or?
not really. I don't have a spreadsheet for this per se. I do look at this headline number itself, right? So, for instance, what I would typically do is just say retail, US retail sales. I used to have it in a spreadsheet before, but then I realized there's no point in wasting my time on this because there are many more websites that give you everything you need, right? So you could go to trading economics, for instance. Let's say you go to the 5 year, yeah. Um,
Yeah.
what information can you take from this? Not much, right? If you look at on a 10-year basis, we do know that heading into a recession, this is what we see. And coming out of a recession, this is what we see. But anyway, this is a lagging indicator. That's why I don't focus too much on this. If it was a leading indicator, I'd probably be a lot more organized and have my spreadsheets and everything. But nonetheless, it gives you a good idea of what the US consumer is doing. So you have to be on top of this. If you also look at the last, let's say, 3 years, right? We haven't had a drop like this in a long time. Yeah. November
Hmm.
2022 was 1.2% down. Other than that, let's say February 2023, down 1.1%. Other than that, you know, this is probably the first time it could potentially go outside of this confined range. So these are the things we have to watch out for because we're always on the lookout for turning points, right? Because if the market is positioned for a positive US consumer and it's not actually playing out this way, we have to be aware of this. Yeah. The
Right.
other thing I wanted to show you, and this is a bit more uh, predictive in nature. So this is the US Michigan consumer sentiment. So this is basically a survey of people in the US of consumers. They ask them a lot of questions about how they're feeling about buying, let's say, a new house, a car, electronics, a few other things, and this is basically like an indication of what's happening in the heads of US consumers, right? So if you see in COVID, that got really killed, right? And it never really recovered until 2022. Even the recovery was not the strongest. So typically, the level of consumer sentiment that is commensurate with US GDP growth tended to be around 70. With the COVID, you know, event, it's basically just taken everything out of whack. So we were heading back to 70 and above. If you see here in February, March, the U.S. consumer were quite confident, and then it took a hit, and then now it looks like we might be heading back down, right? And if you look at this report can also be looked at in more details, but what I want to show you is this. So they also asked these consumers about the expectations of inflation about the in the future, right? So they asked them about what's your inflation expectations for the next year. So this is basically what they said. It's not me. It's not me doing anything funny here, right? What was expected was 3.3, and what they actually responded with was 4.3. So that's a big step up in expectations of inflation, right?
Yeah.
If you want, you can look at this in more detail. You have to search for university. Yeah, Google makes my life easy. Yeah, it's not the best of websites, so sometimes it doesn't load properly.
Sorry, to go back to the retail sales data that you were showing, Roshan,
Yeah.
I understand that's a lagging indicator, but I guess it could potentially be used to like time our trades in a way, do you think? Like where, if we're seeing this drop in auto sales, for example,
Mm-hmm.
that would give us some confirmation on our, let's say, automation thesis, and
Yeah,
maybe
it would give you a hint in terms of where to start looking at, right? Let's say you did not
Mm.
have a short in autos,
Hmm.
you're hunting for trade ideas, then you come across this report. It gives you areas of weakness and areas of strength, right? And then
Yeah.
as you narrow it down to one or two segments, then you start doing your industry stock research and you try to ascertain as to whether this weakness will carry on or whether there's going to be recovery. Also, what I did not mention was that you get the data for year over year as well, right? So I was only looking at this, right, month on month. But you could also ask yourself, is this just a 1 month thing? Or, if I were to compare, let's say, versus last year, are we seeing weakness? So let's say if I compare this against December 2023, right? So we're looking at this column here. So you can see the impact of inflation, right? Everything's gone up. But if you look at, let's say this, on a year over year basis, this is starting to come down now. So we are starting to see weakness seeping into building materials prices. Yeah. So that in itself is a big indicator that all these other segments have been going up in price, except for building materials. And I think we're only at the start of this. Maybe if you were to look at the past few reports, you could kind of isolate as to when this drop starts happening. I suspect it's quite recent. And even if the motor vehicle prices have been coming down, the auto parts prices have just gone through the roof. So that's kind of more than made up for any price falls in the vehicle side. So the more you look at these things, the more you will understand it, and the more able you would be to get these types of insights. Okay, this is not loading, so I'm just gonna move on. Let's try it last time. Okay, looks like it's It's doing something now. So wanted to show you something. Yeah, so you can also get some of these charts by income, by age as well. So let's say by income, these are the types of questions that people get asked. So current financial situations, do you foresee them to improve or worsen? Questions around savings and retirement, their views on economic conditions, unemployment, are they buying vehicles or not? So let's just see what people are saying for cars, right? Buying conditions for vehicles. So there are three segments of income, right? There's bottom third, middle third, and then top third. So you can see that there was like a big drop here, and now it's kind of picking back up. But the lower two-thirds have not yet recovered, right? And it's also not like we're seeing massive recovery in the top third. So uh, there are some points where this becomes more valuable than others. So as an example, when I was getting short CarMax in 2022 or something, this is where we were at the time, right? So this was kind of predictive for my thesis at the time. Now, if you look at the chart, there's not much you can sift from that. So, it's not really that valuable. But it's good to just get an understanding of what these guys are thinking. Okay, so that's it on the macro side. Um, one of the earnings I wanted to take you through was Lulu. Are you familiar with this company, Lululemon? Has anyone heard of them?
Yes.
Let's just go through their earnings. So I haven't looked at it yet. I wanted to do it together with the group, so you get to see what exactly I'm looking at in the report. So if you were to just look at the share price, um, actually no, it hasn't reported yet, so this is the wrong one to look at. But anyway, we can look at this because I think this would still be insightful for you. Um, and if I'm not mistaken, I've discussed this in the Discord server too at some point. So I think someone asked me about a stock where I was saying there's a lot of downside, and they were saying this is probably priced in. And then I used the example of Lululemon as one. I think it was Trinet, if I'm not mistaken. You can always go back. Just search for Lulu on the Discord server. It will show you exactly where that was discussed. So what's the story with Lululemon, right? What do they do? So they basically sell athletic apparel, footwear. In other words, what they do is they sell yoga pants, footwear, and a lot of things that are kind of predominantly were inspired by women who were looking for cool, trendy athleisure, right? So more women going to the gym or practicing yoga. And then there was an unmet need from the incumbent companies because most of them were still focused on serving males, right? In terms of athleisure, it was predominantly male driven. So these guys came with fitness mat, yoga mats, which would be pink in color, for instance, and also, female apparel that's been designed for females, in terms of comfort, in terms of design also. And they quickly gained a lot of popularity because of this, right? So they had the right products, and on the other end, there was not a lot in terms of competition. And at the same time, you had this wave of females now getting more into the fitness space, whether it's running, yoga, going to the gym. So it created that perfect storm for companies like Lululemon to just go to the sky, right? So that's the background of this company. So if you were to look at the 10-year history, this is what the stock has been doing, right? So almost like unknown at this point. No one really knows about this company. And then, it just takes off, right? After COVID, it just takes off even more, right? And then if you look at this, right, it went up all the way. So, you start seeing it peaking here, right? Actually, in 2021, it slows down and it goes back to the highs, is not able to make a new high, and then it just sells off brutally from there. So price earnings next 12 months. So are we all following this now?
Yes, sir.
Can someone talk me through what they believe happened to this stock? I'll give you some hints. So in 2020, it was trading at a forward P of around 80. And then from there onwards, it reduced a bit more. It went into the 60s. Now it's trading at a PE of 24 times.
So I think the company has passed this growth phase. They've basically were growing very fast, and
Yeah.
now they reached that scale where they cannot, scale up more.
Yeah.
So
Yeah. Absolutely. So this is a clear-cut case of PE derating. Agreed? And this is of interest for us as both longs and shorts. Right? So it's very important for us to understand these metrics, because that, understanding the relationship between PE and rate of growth, that in itself will give us so many trade ideas. So you can see that the slope of the sales, right, it starts rising in a less steep manner, right? So over here it's very steep, and then from here onwards you can see it's less steep. So we can actually look at this in terms of the income statement itself. So if we were to do annual, right? So you can see the revenue is growing at 25%, 21, 10%, 42%. Then that goes back to 30, 18, and now it's only 11%. Probably this is a better place to see this. So keep an eye on this metric for PE over here, right? And then look at the rate of growth here, right? That should give you a very good understanding of the relationship between PE and the rate of growth. So the reason I'm looking at Lululemon is on Friday it was down 6%, right? So it's been rising from the lows for quite some time. It had one good earnings here, managed to beat EPS and revenue. But now it looks like it's kind of run out of steam, right? Now the question in my mind is, with a poor retail sales outlook or consumer spending outlook, is there potential for us to head back down maybe somewhere here, right? And if we have an earnings report that's not positive, then I can see how this can happen. But before we go into this situation, we need to first of all understand what's the status quo. And basically what I've been discussing, that's the status quo. So this is basically what the stock has been doing in the past. It's attempted a recovery, So I'm sure it's been able to change a few of its metrics, right? But then the question is, has it done enough to be able to go to higher highs, or are we heading back to 320 and below? Because if we are, then there's significant room for us to make good returns on shorts here. So typically in an idea like this, what you don't want to see is growth in margins, right? Because you're looking at it as a short. So margins are coming down on a quarterly basis, but maybe that's not a good way to look at this. Let's look at this on a last 12-month basis. So yeah, margins kind of holding up. It has a little bit of debt, nothing that significant for a 44 billion market cap, right? Let's look at the profitability. Margins are still kind of holding up, but so I think it's just the rate of growth that's the issue. You can see they're doing everything they can to be able to protect the margins, right? SG&A margin is rising, which means that they are cutting. So that means they are doing cost cutting and trying to get as efficient as possible. The gross profit is also increasing. So gross profit would typically increase when you either increase your prices or you try to get better sourcing from your suppliers. Because gross profit is basically revenue minus cost of goods sold, right? So cost of your inventory. So that's improving slightly. And then we want to have a look at the inventory. I think that's where the problem is. So inventory is at the highest it's ever been, but we're looking at this on a annual basis. Let's look at quarterly. Okay, so on a quarterly basis, it's also not the best, right? Why is inventory a problem? Because as inventory keeps rising and sales come back down, the company is forced to do liquidations or discounting, which basically puts a big pressure on the margins. Yeah. So they don't have any issues from the debt or balance sheet perspective. At least it's not visible to me at this stage. The issue is more around slowdown in sales and probably an inventory issue. So if we wanted to go short this company, we probably need to look at the company itself first and understand a bit what's happening under the hood. Let me ask you this question now, as we go into this report. What do you think would be the growth levers for a company like this?
You pointed out margins. That's one obvious one.
But let's just stick to revenue growth, right?
Okay.
So where
international.
So consumer spending, right?
So you can raise prices. Yeah.
Yeah.
You can establish a wider footprint, so have more stores. You can introduce more products at higher prices, so the revenue mix is a bit different from the past, right? So let's say you were only selling yoga pants and now you start selling yoga mats, shoes. So you're adding more products that gives you more revenue streams, to put it that way. But that's about it, right? The vast majority of the revenue growth here would be linked to new stores, growth in stores. Yeah. So that's what the market will always be looking at. This is very important. New company operated stores, they've added 18 new ones. So in total, they've added 18 plus 15 plus 6 plus 4, right? Which is something around 43.
No, the 15 it's included in the 18.
Yeah, it's just very confusing language, yeah? We've added
Yeah.
18 new stores in the Americas. Okay. Okay. So 18 plus 6 plus 4, right? So 28. 28 new stores in the last quarter. So in the last year, they've added around 50 something, 50, 60. Yeah. Okay.
A good comment here.
So
I
almost
think the
like
way we
10%.
phrase it,
Say again?
yeah. Yeah, I think the way we phrase it, we just want to not say that we didn't open like a lot of new stores in North America or in US, right? So this is what I get from it.
See, these numbers in themselves have no meaning, right? You have to compare them against what the plan was. If the plan was to have, let's say, 800 stores by now, then that's a miss in terms of
Mhm.
expectations, right? If the plan was to have 600 stores and they have 749, then that's great because the number of stores will actually be priced into the stock. Yeah. So now the next leg would be to understand. So typically, these types of companies would give us comparable sales, so same store sales. So basically, we can use this as a measure for how well existing stores are doing. So it's probably not given over here. Let me just search for it.
No, it's there in the sales.
Is it?
Global comparable sales increased for
Uh,
percentage.
okay, they call it comparable sales, right? So when I read this, total revenue increased 9%. Global comparable sales increased 4%. So the bulk of the increase in revenue is coming from new stores. Do we agree?
Yeah.
So existing stores are creating 4% revenue increases, and the rest is being brought about by the new stores. So it's very important that these guys open new stores. That's what the data is telling us. Do we agree?
Yes.
Yeah.
So, yeah, go ahead. No, okay. Um, so this is why store count is very important. This will have a lot of focus because everyone knows that revenue growth is dictated by the KPIs around new stores. I think we also need to have a view on China because it's what's the do they say what's the total revenue? So revenue is 318 million. That's like 10% of US revenue. No, 10% of revenue. So not that significant.
Mhm.
But it's
I think I have a
increasing
breakdown.
quite rapidly. Yeah, go ahead.
Mhm. Yeah, I think I have a breakdown. US is around like 66%, Canada is 13%, China is 13%, is
Okay.
12%, and rest of the world is like 9%. But if you
Okay.
look at the total breakdown, I think by stores, I think it is like 46% physical stores. E-commerce is 45%, so this is quite surprising. And over
Mhm.
channel is like 9%.
Okay. Interesting.
Mhm.
Um, yeah, so I'm sure they've been pushing into e-commerce, right? That's been every business's strategy since COVID. So they've kept developing that as a sales channel. I'm trying to think whether China is relevant or not. So if this is increasing at 40% and it's 10% of revenue, let's say 10, 12, okay, maybe not. I don't know. Okay, so just looking at this sets the stage for what you should be focusing on, right? So if you were to write a thesis around this and you're focusing on everything except from store counts, this would beg the question as to whether you even understand what this company is trading on, right? So if you write a thesis, it has to be centered around this and how this would increase or decrease in the future. And then you would have to have a view on pricing as well, whether they have room to increase prices or not. You also want to understand what they're doing on share repurchases. So 400 million in a quarter. So that's 1.2 billion in a year for 44 billion. It's like it's not insignificant, but not that significant either. Okay. So they have authorized more buybacks. Okay. So inventories are up 8%. That's not ideal. But then inventories, okay, this is a dollar amount. So if they have more stores, you expect them to have more inventory too, right? So this metric in itself is not really telling you a lot, but if you look at it as days on hand, days of inventory on hand, that's a lot more telling. Because this is basically telling you, that it will take 148 days for them to be able to clear their inventory based on average sales numbers that they've got, which is quite a lot, right? Typically for retail, this should be around 90 to 100. So basically, the way to think about it is you have 3 months of inventory. Okay. So if we were to look at this as shorts, we'll need to dig a little bit deeper and understand this business a bit more. I'm sure they give more information. This cannot be the only information they put out. Okay, so they had their analyst meeting in Shanghai. It's quite a bet on China, right? Maybe there's going to be more information here. So as an example, they don't make the best yoga mats. That's made by some specialist company. So they're just a brand that I think was a bit of a fad in the last few years. And now people are just getting a bit real and realizing that, all these are just fabrics that can easily be commoditized. Okay, that's basically so. Yeah, so this is basically their plan, right? They want to okay. They want to go to China, Saudi. Yeah, good luck. What else? It's not much in here.
I think there's a slide on their international exposure. I think I am on the same slide. I think
This one?
Yeah, this one. Or maybe 2 slides after that, where they talk about international growth, where we have a timeline.
Wow. So you can see this presentation is heavily Chinese centric, right? It's predominantly like a bet on China now. It's very interesting. This one, yeah?
Yeah, the one above it, I think it just says where we have their timeline to 2026 and we do the percentage of total revenue.
Okay. Look, I think this is something that we look at in our own time because this is taking like a long time to just load on my end. Basically, what you want to see is whether they would be missing on their store openings projections, right? And then if you have a bit of inflation in their costs, are they able to pass that on to their customers. Maybe not. And I think the de-risking, the de-rating here has already happened. And from my perspective, if we have the right fundamentals, we could go back to below 300, especially if there are doubts around the US consumers. I think this will go down quite a lot. So before you go out and short it, just make sure you do some work on the fundamentals. Make sure that your case is sound, and I'll basically explain to you what the market is watching for. So make sure you kind of do your research around these topics, and yeah, this would give you a very good idea of where the stock could be headed next. And it's a large cap, so it's 46 billion. You will not have any issues with options. You'll be able to trade this probably even on a weekly basis. Let's check quickly. So before I go and do deep dive fundamental work on a stock, this is basically what I will do. I'll basically have a think and understand whether there is scope for the stock to move, right? And then the next thing, once I've established that this could happen, I want to see what the options chain look like. So we have options for, okay, so 2 expiries per month. That's what it looks like. No, actually, yeah, every week we have expiries. So that's a good option chain because then it helps you in structuring. So earnings are on the 1st of April. So that gives you a lot of possibilities here. So let's say you want to be long a put. Yeah, let's say you want to be a long a put at 366, right? So let's say you want to do 350. Let's say you have a target price of 300, okay? So if we do 350 or 340, let's say 350, right? It's $15 roughly. And then if we do, let's say, a March expiry, it's just too many now. We said 350, right? Okay, that's so for $3, you'd be able to participate in that spread. And then if that goes to 300, you make 50 for $3. Okay, let's say for $4, you make 50. That's almost like a 13-fold times your money. But this has to go to 300. So the question is, do we foresee this going back to 300? It's not difficult. Yeah. Okay. This is something that I look into a bit more depth because since earnings are that far out, I think it gives us a lot of possibility to participate here. Yeah, that's about it. I don't have much else to discuss. I mean, there are a few names that I've been looking at. There's this one on. It's predominantly a shoe retailer or manufacturer retailer.
It's because of them that Nike has lost some market shares in the previous quarters.
Yeah, I mean it's what do these guys? I want to see exactly which shoes they produce. They're predominantly running shoes, right?
Yeah, I think it's
these...
one of the brand where this Denisman had contributed to develop. You know this Federer, I think.
Yeah, so they basically make these thick sole shoes for running. Yeah, there's this one. So this is another one, a good one to study. The question is whether we're gonna see Similar. One second. So the question is whether we're going to see a similar derating at some point. So with these situations, you don't look at them as the stock is getting derated, right? You look at them a few weeks or months before that happens, so you can prepare yourself for the thesis.
You
This
can
is
see the March 2023 was the first quarter when I was looking at them at that time,
yeah.
and that was around where Nike was actually losing their market shares as well.
Yeah, we could.
So, and you can see that from there they only went up.
We'd actually do this, right? We plot Nike against this. Yeah, so Nike peaked in, let's say, January 2023, and then from March onwards, it was just down. Yeah, that's quite interesting, eh? But Nike has its own issues. It's not just the loss of market share. I think they did not innovate and they just got caught up. But look at the price action on Friday. Not Friday actually, the last week. It was, this is quite a big move, right? And it's not even on any news. So I think the retail sales is impacting on sentiment. It looks like they also got downgraded by Goldman Sachs. So these are the situations to start looking at because these could be potential shorts. Even if this goes from 52 to, let's say, somewhere here, right? Like 40, that in itself is a big move, enough to make you very good returns. The other stock I'm also looking at is this Mosaic. Some of you will be familiar with this. This is a fertilizer manufacturer company. It will have earnings soon. I think it's end of February. Yeah. This is a classic bear to bull market kind of thesis. So the question is a bit around the timing, right? Do we see the inflection this quarter, or do we have to wait for a couple more quarters? My spider sensors tell me that this is probably the quarter it inflects. We are maybe 1 or 2 quarters before this starts hitting the headlines. This is a company that gives very good quality information. So it will tell you information about pricing and volume across all their segments. So they sell they sell nitrogen fertilizers, and they also sell potash fertilizers. Both of them are different, right? And for these two segments, they will give you very good level information to look at and make your analysis. Another company in this space is Nutrien. So they are a bit bigger. They report in 4 days. So I definitely expect their earnings to move Mosaic as well, up or down. Yeah. So I know, Hans, you're long Mosaic, right?
Yes.
So it would be good to just stay on top of Nutrien's earnings, because it's like the bellwether of the fertilizer stocks, right? It will give a very good idea on pricing, volumes. If we look at the agricultural commodities, they've been recovering. So this is the price of corn, a big recovery, and also as the dollar weakens a little bit, you should expect commodities to get an uptick from that, right? So agricultural commodities doing well means that farmers are more positive about the next crop season. So they're going to be using more fertilizers and probably paying more too as demand increases for these fertilizers. The reason I like Mosaic is because they have a big exposure to potash. And potash is a segment that has a supply deficit. So as you do your research work, you will figure this out. And I think you don't need a lot of demand to cause potash prices to rise significantly. Let me see if I can find potash price index here. Okay. So this has been the historical price of potash. You can see, right? It when it inflects, it can really go, a long way. And this is the last data point is December 2024. So we don't go by these names when the price is doing this, right? You try to figure out when it's happening, and then somewhere here, that's where you get involved, and then you're probably out of the trade somewhere here, right? You don't want to, overstay your welcome, because, these factors are they are dynamic industries, right? So you have to understand it from that perspective. Another agricultural commodity that's important to keep note of is soybean. So it's also been rising in price, not as much as corn, but it's still good compared to where it used to be before. Yeah, this is basically the story around agricultural commodities. There's also something I want to talk to you about. I think that's the metric. These commodities are always traded on the basis of supply and demand, right? So the way this works is farmers will have these seasons where they grow the crops, then they harvest it, and then all the harvest goes into inventory. And then throughout the year, depending on demand, that inventory will get depleted. So in a year with heavy demand for, let's say, corn, the inventory will end up relatively low, right? And then the price will also adjust accordingly. In a year where, let's say, the demand for corn has not been that high, then you'll end up with higher inventory than usual, and then price will also accommodate for that. So the reason agricultural prices never go through the roof is because as the price inflects, the farmers just, plant more, right? And then the next year, the inventory levels are higher up and price trades accordingly. So that's why we don't really want to just go long corn or any of these agricultural commodities, because the rallies tend to be relatively short-lived, like maybe 6 months, a year, and then it will eventually fall back down. But if you find a company that's leveraged to that trend, where you get information that's very detailed, then you would be able to form a thesis around it and play it through equities. I think that's a much better way to play these types of moves. Do we have any questions here? Something else I did not mention. So with agricultural commodities, weather plays a big role. So if you have bad weather and the yield is impacted by this, then the commodity prices can go up significantly, because it just means that you won't have as much harvest that will fill up the inventory. So it's a very simple business to understand, very simple dynamics, because there are not many moving parts.
So Roshan, in these kind of situations where like the weather would be impacting the commodity price, I guess fertilizers may not have that much of a role to play in, right?
No, they would, because if the price of commodities are going up, then farmers will use more fertilizers.
To
So
make up for
that's the
poor weather.
function, that's the relationship, right? Farmers don't, yeah, it's actually called stock on hand, yeah. So farmers don't necessarily need to. So there is this graph where they plot fertilizer usage versus the yield, and it's not a linear relationship. So if the commodity prices are not positive from the farmer's perspective, in other words, if it's not on an uptrend, then farmers tend to underutilize fertilizers, because they don't see any value in accessing that part of the curve where they get diminishing returns on the excess or additional fertilizer usage. Yeah?
Yeah, that makes sense.
Because they have to balance out the cost of fertilizers and the marginal increase that they project they would get from additional yield, right? So let's say if I'm using 1 metric ton of fertilizer, the yield is 1 metric ton of corn, right? If I use 1.5 metric ton of fertilizers, the yield might be 1.2 metric tons of corn, right? So that additional 500,000 kg of fertilizer would come at let's say it cost $1 million, right? So for me to make that decision, I would need to see that the additional 200,000 kilograms of corn that I'm producing, I would need to see that this would be well above $500,000, or well above $1 million extra in fertilizers, right? So that's the relationship, right? And typically, what happens is when commodity prices are on an uptrend, then as you go into the crop season, into the crop growing season, then farmers would tend to use a lot more fertilizers, and the same goes with farming equipment and all of that, because that's the only source of revenue, right? And that's tied to the commodity price. So again, there's a lot of money to be made in these boring industries, and they are not that difficult to understand either. There's a lot of material on YouTube or even on the internet, and even the companies, right? Mosaic gives amazing type of information. Probably the best I've seen for this segment. Okay, so I'll end up here. Please feel free to unmute and ask me any questions that you might have. Go for it, Bhavan.
Roshan, did you look at Airbnb?
No, I haven't.
Oh, they had a jump in their latest.
Yeah,
After
so that's I suspect it goes back to the theme of AI and these platforms. Same with Dash as well, DoorDash,
yeah.
right?
Um,
It's back to that list that I shared with you, right? All these tech companies that have platforms that have a lot of room for them to innovate with AI because they have unique customer data. So I'm sure that they've announced something in that space.
mhm. Yeah, I haven't reviewed the latest earning, but
Mm.
before that, I was looking at it, and they
Mm-hmm.
had just introduced in their app a personalized predictor, like it will give you um, the location you might be more interested in to
Yeah,
go and book and
yeah,
interesting properties
that
there,
that
that kind
makes
of
sense.
stuff.
That makes total sense.
Probably that played out, and they had some good metrics that's coming out of that new product. But I was thinking I will have to wait for one more quarter to get a confirmation, but the
Yeah.
market already moved.
See, in business, the closer you get to personalization, the more margin you're allowed to charge. Think about anything you use in your life,
Yeah.
right? The more personalized it is, the more margin you're paying to the company making that for you. So a very good example is you can buy a suit for $20. I don't know if you still get suits for $20, but let's say $100. And you can buy a suit, a tailored suit for $5,000. Yeah. And it works the same way across every business. So if you want to make money in the world, that's the equation to follow. More personalization, more customization, and then you get to charge any price because no one else is able to replicate your offering. And that's the beauty of AI, right? Before, if you were let's say if you were solving everything through an algorithm, which was basically deterministic, it's very difficult to personalize things, right? Bhavan, a clear example is the insurance industry, right? A lot of you would resonate with this. We put people in buckets, right? Either you're smoker or non-smoker. That's about it. And if you look at the population of people, there are so many rating factors you could assign to them, right? Beyond gender, smoking or non-smoker, age. These are the typical ones used by the industry. But there could be many more, right? And we cannot use that level of segmentation because it gets so complicated, right? Your pricing models would just get so complicated. Everything becomes so much more complicated. And then we default to having these categories or buckets. And we never really achieve personalization because of that. But now with AI, I think I'm not talking of the insurance industry. The insurance industry is, there's no hope for this industry in terms of innovation and all. But all these other industries like retail, these platform businesses, there's a lot of room for personalization and significant increases in margins.
Roshan, going back to the theme I had mentioned a few weeks ago, related to the the online markets brokers, basically like IBKR, Robinhood, etc. So these guys, especially Robinhood, has reported results a few days ago. They have extremely benefited from, all the hype around crypto with Donald Trump election, all this stuff. So the stock has skyrocketed since then. I think even before the earnings, the stock was only going up. So this is also
Which
a
one are
theme
you
that I
talking
think
about? Robinhood?
Robinhood, yeah, Robinhood. So I think this is also a theme that we should not disregard because people are, using more and more these platforms, and by this platform also by opening up to crypto, etc. It's a good source of revenue for them.
Yeah, and like if you trade Bitcoin, the fees that they can collect on that basis is minimal. But if you trade all these other altcoins or whatever crap that's listed there, the fees that they collect is just enormous.
Yeah.
Interestingly, I was looking at Coinbase since last few days. It's not been trading particularly well, right? And I would expect it to be, front and center of everyone else, given that, they are such a large exchange of all these crypto stuff. And these guys earn a lot in terms of fees and interest and all of this. And it's interesting to see that the market still doesn't want to take it higher. But, Robinhood, clear cut, right? If you're trading more options, more fees, that's like a clean cut, straight into your EPS. And a lot of operational leverage, right? So guys like IBKR as well. Let's see what they're doing. Look at this. So a lot of operational leverage. They don't have to do more for me to trade more and for them to make more fees.
Exactly. Yeah.
Right? They don't have to employ more people and all of this.
Yeah.
So it's always finding these clever plays with big operational leverage and then just playing them out. Especially, under these types of environment where you know that inflation is going to creep up and, it's going to affect a lot of businesses. So you need to underwrite your holdings from that perspective too. That's a very good example to bring up. I mean, What I've also seen is, some of these exchanges themselves are listed, like Nasdaq and a few others. These guys also make a lot of money when there's volatility or hype. The other thing I haven't discussed in terms of the theme, if the war in Ukraine or Russia dies down, so that in itself could produce a lot of opportunity, especially with companies in Europe or even listed in Ukraine. I'm not suggesting that you go play this out, but all the reconstruction that will need to happen, that's going to get a lot of companies in Europe involved. I think a lot of companies in the US too, especially if Donald Trump is going to lead that whole movement, right? So that's one thing to be on top of.
I have a friend who's basically, whenever he's buying an iPhone,
Mm-hmm.
he would invest the same amount of money in Apple stocks.
Okay.
And after like 2 or 3 years, you're basically getting a free iPhone.
Yeah,
so like
good for him.
Whenever you trust, a business or a company, and their business model, etc. So it's a good idea I would find it very interesting.
Yeah, he should be buying GPUs, not iPhones.
Yeah.
But all these things, it's great when they've worked, right? But you can see very easily how one day they can stop working.
Yeah.
Because it's all correlated, right? The day the correlations work against you, then you don't hear of these stories because no one tells you, right? Because that makes them feel stupid. No one tells you about all the bankrupt businesses they've invested in, or the 50% losses that they've taken, and all of all of these stories. I mean, even in my case, I'm trading options. Do you think every single trade is a 3, 4, 500% win? Absolutely
Of
not.
course not.
There are cases where I'm like, trying to get out at zero loss, or like kind of break even, or maybe 50% loss. It's the nature of the game, right? Because everything that we do here is probabilistic, and it's not I don't want to say impossible, maybe I'm not that skilled, but it's not easy to have like 100% win rate. The best of traders have a win rate of 60 to 40. That's enough to make them a fortune.
Yeah, I would be interested one day if you can talk about your approach to IPOs, because I noticed most of IPOs prices crashes after the introduction.
I don't get involved in IPOs. I don't think
I thought you were trading
retail should get involved in IPOs.
Yeah, because doesn't seem like a good idea.
Yeah, it's basically like a fool's game, right? So the investment banks who are underwriting the offer will put up any number that suits their clients, right? Because first of all, you have to understand why they're going to IPO, right? And nowadays it's mostly to provide an exit to their venture capital funds. So like they're basically abusing the public markets to be able to exit the investments with a return that they want, right? So let's say they want a 50% return, then they will set the price accordingly. Let's say they want 100%, the price will be set accordingly. And then the reason you see it fall is because the fundamentals just don't work, right? And they have these lock-in periods and so on. So these dates are well known. People start selling it ahead of the VCs or the pre-IPO investors themselves selling their shares, because they know that the CEO has, let's say, 20 million shares and he can only sell as from this date. So as from the, let's say, the first of March, he's definitely selling, and the price just keeps going down. But it doesn't really matter to him, because even if the price is down 50%, he's still making 3, 4, 5 times his money based on, you know, where he entered the price. But then there are also a lot of stupid money, right? So as long as there's stupid money, these companies will keep, doing their practices. But anyway, there are many games happening in the stock market. So you pick the ones where, you think you have the best opportunity, and then you stick to that.